Good evening and welcome to F8 Audit and Assurance, and this is live revision class number 1. Okay, so welcome everybody. Can't quite believe on February the 1st we're already starting revision, but the sooner we start, the sooner we can get moving and the sooner we can move towards a conclusion. Before we get down to the actual F8 itself, one or two little reminders for you. We have a total of 4 classes of revision. We have tonight, and then 24 hours later we have tomorrow night. We then have a 2-week break and come back and do the same thing again. 2 classes back to back, so we can have a nice intensive push to halfway through the course. Give you a couple of weeks to solidify your technique and your understanding of those, and then we come back for the last half in a couple of weeks' time. Also a reminder that shortly before the actual exam itself, we will have a final 1-hour revision, question and answer, workshop, panic stations, whatever you want to call it. My chance to remind you of what you're going to do on exam day, your technique, what to be thinking of, and for you to ask any final questions about things that are causing you concern. The exam for F8, of course, is on the first day of exam week, Monday, March the 7th, which is also my birthday. Isn't that nice? But because the exam is on the Monday, that final 1-hour revision question and answer session, will be at the end of the week before. There is a revision planner up on your platform. The revision planner shows what we're going to be doing in the classes, tells you the date for that final 1-hour question and answer session, and also shows you the 7-day window later in February for when you can attempt and submit the mock exam. I mark all the F8 mock exams that go through interactive. Please have a go at it, submit it, let me give you my feedback. I don't mark the F8 exam for the ACCA, but I do mark the P7 exam for ACCA, and the techniques and the marking methods and the marking messages we need to give you are very much the same for both papers. Okay, so there's a little bit of admin side of things. If at any point during this class you want to ask me a question, then just type it in. I can see it over to my left here, and I'll answer it on camera. And if, oh, hang on, I always forget to do this. We need to do that, and I will disappear down to the corner. If at any point you want to contact me outside of the class time, email is probably the best bet. You can also contact me through the platform as well. If it's anything technical, IT issues, admin issues, don't ask me because I won't know the answer. Use the admin or technical help button on the platform. Okay, right, that is enough of that. Let us get going. We have 2 hours and 45 minutes in each of our 4 sessions. We'll see how we go with 2 hours and 45. I think you need a break at some point in there. I can probably just carry on forever. We'll see how we're going about halfway through, and if necessary, we'll take a fairly short 5 to 10 minute break just to refresh, and then we can come back and power through to the end. Okay, let's begin our revision then. So, your F8 exam paper. Just a reminder that we're looking at 12 multiple choice at 20 marks, and then 6 long questions totaling 80 marks. And that will be 2 longer 20 markers and 4 10 markers. And the absolutely critical thing to realise is that what we can expect to see is that in the MCQs, it will be largely knowledge, probably about 15.5, possibly even more extreme than that. Whereas the long questions will be something like that. So overall, yes, there are knowledge marks on the paper. So if you know your stuff, there are marks to be had. But you cannot pass this paper unless you are scoring a decent chunk of those 65. Now, of course, knowledge takes a bit of hard work, doesn't it? You've got to go and get it into your head. If you understand it even better, it's more likely to stay in your head. Whereas practical requires practice. And it requires good technique to practice and then implement on exam day. So in terms of that practical stuff, the big core areas that we are going to be focusing most of our effort on are as follows. And I'll do this in order of marks importance. Substantive procedures or substantive tests always has more marks than any other topic on this paper. It is virtually 100% practical. There's almost nothing to know. It is all about, here is a situation, what procedures would you do? And that requires thought and it requires technique, both in coming up with your ideas and also how to explain those ideas. The second biggest area for marks on F8 tends to be internal controls. And the third big area tends to be audit risk and response. And those three items just up there are typically around about 45 to 50 marks out of 100. So clearly, if only three things are half the exam, those three things become very, very important. You cannot afford to be weak on any of them. The other two main core areas, we'll do this in a different colour because they're not quite as important, are ethics and audit reports. And then on top of those five areas, which tend to be the backbone of the 6 long questions, there's a couple of other areas which are mostly knowledge, but can pick up some marks, specifically internal audit and corporate governance. So the core areas require a lot of practical, a bit of knowledge, especially audit reports, whereas internal audit and corporate governance, to be honest, if you know them, you probably have got enough to get through the paper. The way I do revision is same order as tuition, partly because it seems to make sense. It also helps to spread out the more important areas through revision rather than trying to do them all at once. And also, I like to start revising on the first few areas of the syllabus because those, of course, are the ones which you may well have studied the longest ago. So it helps to get you back up to speed. Right, I guess it is time for us to begin. So, on the subject of beginning, let's have a reminder of how we passed this exam. We can then start to revise some of our first technical areas and then we can move into some exam questions. The exam questions that I'll be doing on each of the revision sessions are on the revision planner, but I have uploaded them and they'll appear up on the screen So don't worry if you've not got them with you, it's not important. Right, F8, exam technique. Probably the most important thing I can tell you about F8 is that each core area has its own technique, both for coming up with good points to write and, very importantly, how to write them. So we'll look at each of those techniques as we get to that core area. However, there are some bits of technique which apply to everything. For example, a lot of the time people fail F8 because they say things but never explain their importance. So for example, people will write, this increases inherent risk when doing an audit risk question without actually saying what it increases the risk of. People will say, I would inspect the invoice. I would discuss this with directors, without saying what you're actually discussing or what you're looking at the invoice for. There's a lot of stuff on an invoice. Names, addresses, dates, amounts, descriptions of products. What exactly are you checking? You have to be specific. One of the most common questions I get asked as a tutor is, how much should I be writing? Am I writing enough? Well, as a rough guide, I would aim to write 2 to 3 lines for each 1 mark you are trying to earn. Not 2 to 3 words, 2 to 3 lines. Now, depending on how big your handwriting is, I would say that's probably about 25 words. And sometimes people think that's too much, I can't possibly do that. But the reason is failure to explain. I mean, look at it this way. If I write inspect the invoice, I've got 3 words. Doesn't really mean anything. If I write inspect the invoice in order to agree the selling prices on the invoice match the official price list of the company to verify accuracy of amounts, I've got 26 words because I explained specifically what I was checking. So tell yourself to use the word because or in order to or to verify. If you explain everything, you soon get enough words on the page. And one final point I'll make before we get into the actual technical revision itself and a bit of ethics. The whole point of an exam is not to test that you've memorized things, it's to test that you understand things. And with auditing, we have a process that is pretty much continual. At the AGM, we are put up to the vote to shareholders. Assuming we are voted in, we start planning our audit. We are assessing risks, planning things before the accounting year has even finished to make sure we are ready to start our audit work, both after the year end and also at the year end for certain tasks. We assess the client's controls to see how much we can rely on those and how much we will have to do of substantive testing, checking the numbers ourselves. At the year end, we will attend stock takes, write to the bank to get confirmations, maybe write to customers, suppliers to do the same thing. And then in the weeks and months after the year end, we will come back to the company's premises and check that the figures they put in at the year end appear to be true and fair. Which means when we are doing the substantive testing, we are after the year end, meaning things that have happened after the year end may help us to get evidence. A year-end customer might now have paid. Year-end inventory may well have been sold. So one of the things that the examiner is testing is, do you understand where in that audit process you are in each individual exam question? Interesting point there. Some students have said, Paul, I can see the ACCA are not releasing the full exam papers anymore, and I can see they've done a September plus December paper and they've given us 3 questions from each. But I don't know which questions come from which paper. Do you? Well, the answer to that is yes. It's not because I've seen the actual question papers. No, I haven't. They're not releasing them anymore. But I know what's come from what, simply by reading the stories, because you can tell from the dates whether that question must have been set in September or must have been set in December. You should give it a try. It's actually quite a good test of your understanding of the audit process. So, watch the dates carefully. You are sitting your exam paper on March the 7th, 2016. When you sit the paper, many of the questions will have dates in. Probably dates in 2015, 2016, maybe even into 2017. Compare every date you are given with March the 7th, 2016. You'll see that as we practice the questions going through. Okay then, I think it is time to stop being general and to get down to some specifics. So let us begin with core area number 1. And ethics. We'll start with a quick reminder of what you meant to know, then we'll look at technique, and then we will look at a couple of exam questions. Now, there are no guarantees as to what will come up and where it will come up, but this has typically been a 10-mark question. So not one of the big 20s, typically a 10. What do you need to know? Well, there are 3 main areas that a question could cover. One of them gets examined a lot and the other 2 get examined much rarely, much more rarely even. The big one for the exam are the threats to objectivity and the safeguards that auditors put in place to try to manage those threats. And we'll be looking at that one first. Secondly, confidentiality. And thirdly, conflicts of interest. So those are the big 3. 2 of those, if you know it, you know it. There's not really much skill involved. Threats to objectivity, on the other hand, which is the one that comes up the most, is practical and therefore has some technique. So let's deal with the 2 rather easier ones first, confidentiality and conflicts of interest. So, confidentiality, one of the 5 fundamental principles of ethics. And what does it say? It says that we should keep our clients' information private. Why should we do that? Well, one reason we do that is to protect our client. If you go and tell Apple what Samsung are getting up to, clearly that's going to damage Samsung's competitive position. So keep quiet. But another reason we keep clients' information private is that if they cannot trust us, they won't tell us all we need to know. So the standard rule is you tell nobody anything about what you know about your client. However, there are exceptions, as there are to every rule, it seems. And those exceptions can largely be split into two types. Sometimes the law tells us we have to go and tell on someone. No way around it. We just have to do it. And sometimes we don't have to disclose, but we might. Now the law is nice and straightforward. If it says we have to, then we have to, don't we? Classic examples. If you think your client is involved in money laundering, if you think your client is funding terrorism, all sounds very exciting, doesn't it? I don't think I ever saw any of this while I was an auditor. Then you have to disclose. There are other examples, basically any really serious crime. When might we disclose? Well, the main one here is where you think it is in the public interest to disclose. As accountants, we are professionals, and we believe that one of our jobs as professionals is to try to do what is best for society overall. So if there's something going on at your client, and there's no law saying you have to report them, but you think society would be best served if we did report them, then you report them. Now, if you are going to take that approach, you are taking a bit of a risk because you have no legal backing. Trying to do the best thing is a wonderful effort, congratulations. But standing up in court and saying, I did it because I thought it was the best thing to do, is a rather dangerous defence to use, so get legal advice first. There are other reasons why you might disclose. Your client, for example, might say, I don't mind if you tell people about this. But anyway, those are the most important bits about confidentiality. If it does come up and it says that someone is asking you for information about your client, if you're not sure, take legal advice. And that's it, that's confidentiality. It's not very difficult. If you know it, you know it. And as a result, it does not come up that often. Let's now look at conflict of interest. I mentioned Apple and Samsung just now, so let's stick with them. So, can I be the auditor of both of those companies? They are clear competitors in the same industry. Can I do it? Well, the first thing to notice is, yes, absolutely you can. After all, if you understand Apple, If Samsung is that similar, you would surely understand them as well. There are some obvious benefits to auditing several companies in the same industry who have very similar products, structures, laws and regulations to follow. Makes a lot of sense. So yes, you can do it. It is not odd in that respect. But it creates dangers. The main dangers it's going to create are the risk of confidential information, passing from one company to the other, because you as the audit firm are in the middle. You act as the point at which information could pass between the two companies, either deliberately or accidentally. Now, of course, this could happen with any two clients, but if they're two clients who have no interest in each other, who cares? When you've got two companies who clearly are interested in each other, either because in this case they're competitors, or maybe because they are in some sort of legal action or dispute, then the risk is clearly magnified. But it's not just about confidentiality. Imagine Apple came to you and said, I don't know, let's make something up. The Canadian schools network want to have computer technology in all of their classrooms. And also, the Canadian Schools Authority has decided that every pupil should be provided with a mobile phone from school so that they can block it against having any software on it apart from the ability that their parents can get in touch with the child or teachers can, and that's it. It's quite a good idea, actually. Why didn't I think of this before? And Apple have come to you and said they want to bid for that massive contract, and they'd like you as their auditors to help them put together some financial information to show how well they would do it, how they would price it, and stuff like that. You, of course, want to help Apple out. They're your client, and you say, oh yeah, we'd love to help with that. And then later the same day, Samsung phone up and say that they want to bid for the same contract. Can you help them? It's not just about confidentiality, you see. It's also that any advice for one of these two clients will probably harm the other. If you help Apple, they'll win the deal and Samsung will suffer. And the point is that as auditors, we are not meant to help one client over another. We should act in the best interests of all of our clients, and where there's a conflict, this is difficult. So, because of that, it is possible to audit both companies, but we need some safeguards. And the great thing about conflicts of interest is the safeguards are always the same. So if you know them, you know them. To avoid the confidentiality problem, don't send the same people to both of the competing clients. Say you have two separate teams. If possible, if you're a big firm of auditors, from two separate offices of the firm, keep the audit records totally separate to avoid the risk of information on one file getting to the other. Now, back when I was an auditor, before the world of computers really took on, this meant the paper files being stored in two different buildings and locked away so people couldn't access them. These days, I guess two different computer servers. Don't store them in one location where someone could easily cut and paste something from one to the other. Keep them separate. And anyone working on these clients is told that there are strict confidentiality rules, stricter than normal, to make sure they appreciate the risks. And if you are planning to do this and audit both of them, you must make sure you inform both companies that you'd like to do it. Give them both the opportunity to say, actually, we'd rather you didn't. And if they don't like it, you can't do both. Anyway, they vote you in, don't they? So if they don't like it, you simply won't get voted in. So make sure you inform both companies. If for whatever reason you think you cannot do both, then don't. The most likely solution is you'll only audit one of them. And we should not forget that auditing is a commercial business. We are trying to make money. You are allowed to select the client you would prefer to audit, subject to all the other ethical issues in here. Okay, so there we go. That's conflicts of interest. Second area covered. If you know it, you know it. Let's now take a look at our first practical area and then take a look at our first question. Threats to objectivity. Now, before we get into any of the detailed revision, it is critical that you understand what this is all about, because most students clearly don't. They have the knowledge, they've remembered self-interest and self-review, and yeah, well done. But when it comes to explaining what any of that means, they're clueless. So let's start with the understanding. What does this actually mean? Auditors need to be objective. Because if we are objective, in other words, we have no other outlying issues in our brains affecting our judgment, we are more likely to give the correct opinion in the audit report. And after all, our job is to give that opinion. So if this is more likely to make it correct, we should do it. Be objective. But it's not just about being objective. Our opinion is of very little value if nobody believes it. If people don't believe we're objective, there's not much point giving an opinion. If people think we've given a fair, objective, honest opinion, it means that shareholders are more likely to trust our opinion. So how does that become important for the exam then? Well, the reason it becomes important is this. I told you earlier on that the key in F8, or one of the keys, is explanations. Well, I've just told you that objectivity is about giving the right opinion and people believing your opinion. As a result of that, when you are explaining ethical threats to objectivity, you need to say why you think the audit opinion is at risk of being wrong, Or if it makes more sense in the circumstances, why shareholders might not believe the auditor's opinion. Because that is what threats to objectivity are all about. So if you remember that, which is really, really important, it will help to make sure that whenever you explain a threat to objectivity, you're explaining it in the right sort of way. Let me show you what I mean. So that's the key. Hopefully you remember that there are 5 or 6 different types of threat to objectivity. Always been a bit of debate about the 6th one, and I'm beginning to think your examiner would be quite happy to stick with 5. So let's stick with 5. I'll mention the 6th one at the end, but we'll do it separately because it seems to be less important. So self-interest. Imagine you've spotted a self-interest threat. What are you going to say? You are going to say, the auditor might give the wrong opinion, i.e., ignore financial statement mistakes in order to, and then it rather depends on what the story says. But the point being, the auditor is giving the wrong opinion to protect their own position. That's what self-interest means. Self-review. Is of course where the auditor, during the audit work, is checking things that they themselves were involved in. The risk the auditor might ignore their own mistakes and therefore give the wrong audit opinion. So notice the consistency in how I'm explaining this. I'm always bringing it back to the fact the opinion could be wrong or might be viewed to be wrong. Let's look at advocacy. Advocacy is the classic example where shareholders might not trust the opinion. It's not about giving the wrong opinion. It's the fact that people might start to assume you have because of the situation. So what's going on with advocacy? Advocacy is where the auditor represents the client's position or view, is on the side of the client, if you see what I mean, in some respect. And therefore, because they are on the side of the client in that respect, shareholders might think that the auditors were on the client's side when they audited the accounts and therefore avoided spotting mistakes. In fact, let's just reword that, I think. So, shareholders might assume auditor also on client's side and ignored financial statement errors. In other words, therefore giving the wrong opinion. Now, I'm not going to do this for all 5 of them because there's no need. You get the idea, I think. If you can spot a threat and say, oh, that's a self-review threat, oh, that's an intimidation threat, congratulations. Do you know what? 95% of students spot them because they're easy. They're easy to spot. What they're not so easy to do is explain. So if this comes up, you must tell yourself, I'm going to spot the threats, just make sure I explain them. And try to link it back to, there is a risk of mistakes in the accounts because there is a risk that the auditor does not report the right opinion because. And if you use that sort of approach, your explanation should be fine. Okay. Now, I won't mention familiarity intimidation, otherwise this becomes a teaching course if we're not careful. There is one at the end, and there's some debate over whether this threat actually still exists, and that is the management threat. And this is where the auditors are taking decisions for the company. So instead of just acting as auditor, the clients ask you for some advice about something, and if you're not careful, you don't just advise them, you actually tell them the answer, and they just do whatever you tell them to do. And the danger is, if you effectively make the decision for the company, it means the auditor is seen as part of the board of directors, but we need to be seen as separate. So our opinion is trusted. Very important that auditors are seen as separate from clients and that there is a sort of distance between them. Okay then, well, isn't that a nice start? So I've gone through 45 minutes so far and we've not done a question yet, which is very, very naughty. But that's given us a chance to get back up and running and remind ourselves of some of the things we need to know. It is time for a question. And the first question we are going to take a look at tonight is from the June 2015 exam. The current exam format, by the way, with the multiple choice questions and the 6 long questions, started in December 2014. The exam format was slightly different before then. Same syllabus, just different style of it. So every time we can do questions from December 14 or afterwards is no bad thing. And we're going to take a look at question number 1. So there we go. Thursday, 4th of June, oh, my arm's disappeared, 2015. Audit and assurance, just to prove I am not making this up. We will fly past the 12 multiple choice questions, exciting as they are. And we will go to question number 1. Now, whenever you go to an exam question, do not read the story. It is very tempting with all that detail to want to get in there. Don't. This is a technique-based paper. Before you get embroiled in all the lovely detail, we need to understand what the question is asking. Now, I would be doing this in the first 15 minutes of the exam, the reading time. You can't write your answer yet, which is good because it stops you trying to do it. And in those 15 minutes, I'm going to read all the requirements and see what the question is asking to remind myself of the technique. I can see it's worth 10 marks. They're split equally, so there's going to be 5 for that and 5 for that. It says, identify and explain 5 ethical threats which may affect the independence of Beach's audit of Willow. Independence is pretty much the same word as objectivity. your examiner tends to use them interchangeably. So the moment I see that, I am thinking it's going to be self-interest, self-review, advocacy, etc. And as we've just seen, in each case I must explain why it is a threat, not just state it. I've got to come up with 5 of these things and they're worth 5 marks. So I'm sure you can do the maths. 1 mark for each. That will be half a mark for identifying the threat and half a mark for the explanation. A lot of students never explain them, meaning they've lost half the marks already. Part 2. For each threat, explain how it might be reduced to an acceptable level. And those are the safeguards. So for part 1, 5 things. For part 2, 5 things which match the 5 things in part 1. As always, I'm going to try to write 2 to 3 lines for every mark I am trying to obtain. Now your examiner has said 5. It is possible when we read the story that we find more than 5 threats in there. If she says 5, the markers will be told, mark everything the student writes and give marks for the best 5 threats. Now my advice to you is if it says 5, provide 5. You don't have time to provide 25. If you're pretty sure you know what you're doing with this, then the 5 you provide should be pretty good, shouldn't they? If you think you can see 6 and you're not sure which to go for, you might want to provide 6, but this will put time pressure on you for later in the exam. The best thing for this exam is have good technique and provide 5. Because let's face it, if your technique's rubbish, the 6th one is going to be just as bad as the first 5, isn't it? Okay then, let's go have a look and let's put an answer together. Given that part 2 of this question is clearly linked to part 1, I'm tempted to go for a 2-column approach, which is perfectly allowable, but we must stick to sentence writing, even though we're in columns. So in my answer, I'm going to put threats over here, make it clear to the examiner that I'm doing part 1. Part 2, safeguards can go over here. Now, when we practice questions, sometimes I will write them in full, but not much, because if I write the answer in full, the question takes a long time. Most of the time, we will be doing answer plans. But given this is the first question we're doing on revision, as we go through this one, I'm going to start at least by writing full answer. We won't do it the whole way through, I suspect, but we will start with full answers so you can see roughly the level of detail and explanation we're aiming for. Right, let's read the story then and see what we can find. You are an audit senior and have been allocated to the audit of Willow Wands, a listed company which has been an audit client for 8 years and specialises in manufacturing musical instruments. Now that could have just said an audit client for 8 years. The examiner says they're listed on the stock exchange. Now that might prove to be important. Typically for listed clients on a stock exchange or any other key audit client, so more public interest entities they're known as, higher profile clients, the ethics rules are often a bit tighter than they would be for other clients. Now at the moment I've not read the story, I don't know what's coming up, but there's a reasonable chance that in at least one of the things we're going to write we'll have to say because it's a listed client, da 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 da. I also noticed they've been a client for 8 years. Eight's an interesting number in ethics because 8 is bigger than 7. And 7 years is typically how long we are allowed to audit the same listed company client before we have to start rotating staff. So I'm already thinking staff rotation is going to be an issue, familiarity threat likely to be coming up, but let's see. Okay, off we go then. So it says Bethan Oak was the audit engagement partner for Willow and she had completed 7 years as the audit engagement partner. She has recently been rotated off the audit engagement. Oh, how disappointing. I'm not going to be able to say familiarity threat rotator off because they already have. Oh, shame. The current audit partner, Sandeep Pine, has suggested that in order to maintain a close relationship with Willow, well, don't those words just scream at you, familiarity threat? I mean, that's what close relationship means, doesn't it? Bethan should undertake the role of independent review partner this year. Well, that's a pretty ridiculous comment. Why did you rotate her off the audit? Because she's not independent. So now you're going to make her the independent review partner. Ridiculous. So there's one that can go into our answer. We'll come back to it. Let's keep moving through the story. In addition, Willow has requested that Bethan assist them by attending their audit committee meetings, as a non-executive has recently left the company. Well, if she attends audit committee meetings with the remaining non-executives, I wonder if we can see a potential threat in there. Not necessarily the most obvious one in the answer, but it's an issue. Willow has also asked Sandeep and the other partners at Beach to help them in recruiting a new non-executive director. Help them, eh? I'm thinking something there. The total fees received by Beach for last year equated to 16% of the firm's total fee income. Do you know what? 16, rather like 8, is an interesting number. 8 because it's bigger than 7 and 16 because it's bigger than 15. I think you know what I'm talking about. We'll come back to it. The current year's audit fee has not yet been confirmed. But along with taxation and other possible non-audit fees, the total income from Willow this year could be greater than for last year. Last year's audit fee was being paid monthly by Willow, but no payments have been made for the last 3 months. Ooh, overdue fees. I think that's got to go in the answer as well. Well, I've found 5. But there is another sentence coming up. The audit manager for Willow has just announced he is leaving Beach to join Willow as the financial controller. Well, if one of our audit staff is going off to join the client, I think I am meant to talk about that as well. Will this be available for us to catch up on later, as I'm having difficulty with the presentation? It just goes to black screen and I can't hear or see. I think you have an internet problem, my friend. The answer is yes. All of these are recorded and will be uploaded on the next working day. So this should be up tomorrow morning. Okay then. So I've got 6. I only actually need 5. Common sense, therefore, is don't start at number 1. Go and pick out the ones that you find easiest to explain and easiest to give safeguards for. There's no need to do it in order. If you go for the easier ones, it means that by the time you've done 5, the 6th one will be the one that you're the least happy with. Surely this makes sense. Now, obviously I'm your tutor, so I'm incredibly happy with all of them. So I will do them in order. Right, the role of independent review partner for the year. Okay, here we go then. Threat. Now what I like to do is put in a little heading just to help the marker know what I'm talking about. So I would write something like review partner, so I know the marker knows which point I'm going to be talking about. And then I would write something like this, thinking 2 to 3 lines to get my mark. If Bethan acts as review partner, she is reviewing files of a client she is very familiar with. Because she's been 7 years as the partner responsible for this client. I was about to say this creates a familiarity threat, but I've already said that, really, haven't I? There's the word familiar. This familiarity threat leads to a risk of reduced professional skepticism. Whenever you talk about familiarity, reduced professional skepticism makes a lot of sense in terms of your explanation. What am I saying? She might not challenge the audit work enough. I mean, let's face it, the new audit partner, first year as partner, may well have instructed the team to pretty much do what they'd done in previous years on this client, which of course was set up by Bethan. So if she reads through the audit files and says, yep, that's what I did before, she's just going to accept that it probably is right because it's what she did before. But what if what she did before wasn't right this year? So she should not be doing it. Right, we need a safeguard. Just before we do that, I've written just over 8 lines there, but 8 very short lines with not many words on each line. If I'd written those across the page with no gaps, it would have been about 3 lines of writing. So it's just right. Now we need a safeguard. Well, the safeguard should be fairly obvious. That is, Bethan should have no involvement in this client for several years, even as review partner. Doesn't feel like 2 to 3 lines if I'd written it all the way across the page, so I will keep writing. Instead, a different partner should do the independent review who has had no involvement with this client before. There you go. First point in the answer. 2 to 3 lines on the left, 2 to 3 lines on the right, 1 mark each, explanations, nice and detailed, perfect. Now, as I said, I'm not going to do that for everything in the answer because it does take a while when we do them in detail. But let's move on to a second point. What was the second point? It was attending their audit committee meetings as a non-executive director. So again, I'd put a little heading in the answer just to split it up a bit and alert the marker to what I'm going to talk about. Right. So, if Bethan attends audit committee meetings. Now, this is one of the harder points in the answer, I think, possibly the hardest. Why is this a concern? What threat to objectivity is being caused here? Well, this is partly testing your understanding of what audit committees do. What do? They oversee a company's financial reporting, and they oversee the external audit of that financial reporting. They also are involved in picking the audit firm that is nominated to the shareholders to be appointed, and they also help arrange the audit fee with the auditors. If someone from the audit firm is sitting on the audit committee, surely there is a self-interest risk that that person makes sure that our firm keeps the audit and no other firms are considered, possibly argues the audit fee should go up, and also says that the audit process is going really, really well and we can just leave the auditors to it and not get in their way. That would be my main issue. It's not the only one though. Another one is that if you're involved with the non-executives who are part of the board of directors, you could start arguing a familiarity threat here because you're too close to the directors. I doubt I would say management threat, although because non-executives are non-executive. They don't manage, they oversee. But I'd go for self-interest here. So, if Bethan is on this committee, a self-interest threat arises. She could use her position to ensure the committee does not query audit quality increasing the risk of the wrong audit opinion. However, as I said, she could also use her position to ensure our firm keeps this client forever and at an ever increasing fee. So, self-interest, highlight it, then provide an explanation. As is so often in these questions, the safeguard seems to be rather easier than the underlying threat. Because once you've said she should not be on this committee, the answer's pretty simple, isn't it? She should not be on the committee. In fact, none of our firm's staff or partners should be on the audit committee. It should instead comprise independent non-executive directors or NEDs. Now I'm looking at that and I'm thinking that doesn't look like 2 to 3 lines. If I wrote that all the way across the page, it's looking a little bit short. So I'm going to try to add something. And if you tell a client not to do something, the most sensible thing to add is what they should do instead. So, the request should be politely declined. Now, I've already really said what they should do, shouldn't I? Get an independent non-executive in. One thing I would say is that one of our partners could attend the committee as a guest on rare occasions to answer audit related queries. You see what I'm trying to do here is trying to make sure that whenever I make a point, I've got enough words on the page to persuade a marker that it's worth additional credit. When your exam paper is marked, we don't read the entire thing, sit back and go, how much is that worth? We tend to mark it by saying, oh, self-interest threat, there's a half. Oh, here's an explanation, look, there's another half. You've got your mark. None of the firm's partners should be on the audit committee. It should comprise independent NEDs, yeah. Requests should be politely declined. Yeah, that would be worth a half. Now, you're only going to get one mark on there, just so you're aware. That would also get a half. That would also get a half. But it will be maxed out at 1. So on your script, if you saw it afterwards, there would be a box saying max, max, and those would disappear purely because you've earned enough marks already. Right, isn't this going well? I think the one difficult thing about this question is possibly 2 of the harder points are 2 of the first points you spot. It gets easier. Okay, so we'll go down now and we will go to a summary answer or notes for the rest of the answer. What else? They wanted help in finding a new non-executive, didn't they? And I'm looking at that and I'm thinking another self-interest threat. Because there's a risk. There's a risk that I can't write properly. So self-interest, we might well recommend someone who will support our firm. I might also suggest a management threat. Because a recruitment decision should be made by the board, not by us. Solution. We can advise the client, yes, we could advise them on what sort of CV content, maybe where to advertise, maybe even interview questions that they should ask given the nature of the person they're looking for. But we should make it clear that the final selection should be made by the client. Then what else was there? There were the fees, weren't there? Currently 16%, and it looks like they're likely to rise. Well, this one creates self-interest and intimidation threat. Why? Big client. And the auditor's potentially scared to upset them. Equals ignore financial statement errors. Solution? Well, it said in my story, I think, that we were doing audit and tax work. We're doing more than one job for them. So if that percentage is not likely to fall, see what would happen if you stop doing the tax work, what impact would that have on fees, and if the audit fee is substantially less than 15%, maybe it's okay. What else did we have? I've forgotten. We've done number 1, we've done number 2, we've done number 3, we've done number 4. 5, outstanding fees. This comes up so often. Well, if there are outstanding fees, this creates a self-interest and, again, intimidation threats. Why? Because there's a risk we don't report financial statement errors yet again, because we are afraid that the old fees will not get paid. Might also be mentioning that outstanding fees are similar to a loan to the client. And loans to clients are banned, so it's indirectly very similar to that. So, solution? If you've got outstanding fees, ask the client to pay them before work continues. Which, when you think about it, is common sense in any walk of life. Why would you rack up more work on a client who hasn't paid for the last lot? That's just stupid, isn't it? And then the last one was a member of staff joining the client, was it not? Audit manager just announced he is leaving Beats to join Willow as the financial controller. Okay, so let's look at that one. Now, the first thing to note is that the audit manager has not left our firm yet to go and work at this client. At the moment, the audit manager is still here. So if we do the audit of last year's accounts, we are not going to be auditing the audit manager's work. They don't work for the client yet. It's not that. That's not the problem. The rather bigger problem here is that if the audit manager has announced they are going to work at this company, well, when did they start applying for this job and interviewing for it? It wasn't last week, was it? If they've said they're going, that's the end of the process. Which means this audit manager has known for some time that they were applying for this job and that they were being offered it. Equally, the client knows that this person has applied and has been offered the job. Now, this actually raises quite a few concerns. If you know you want to go and work at a company, you don't want to upset them, do you? If this process has been going on for a while, there's a danger that in last year's audit, the audit manager has ignored financial statement problems because they knew they'd almost got the job offer and they didn't want to rock the boat. So that's one concern I've got. Second concern I've got. If the audit manager now goes and works at that client from next week, next month, when we go and do next year's audit, we won't be auditing his or her work because they've only just joined, but the person we will have to talk to get evidence from is the audit manager. So someone we know is now one of our key contacts at the client. And that's going to be a problem, isn't it? Because that is going to create familiarity threat. Because our staff might trust him too much because they used to work for him or with him. And another thing that concerns me is that the audit manager has come from our firm and therefore knows our audit methods. Now, that's not really an ethical threat as such. That is not a concern with our firm, it's a concern with someone at the client. Right, so what do we do about this then? Well, it seems to me we've got a bit of a problem if our audit manager goes and works at this client, but they've said they're already going. Because this causes such problems in reality, typically an audit manager's contract at our firm won't allow him to take a job at the client. So one thing I'd be doing is read his employment contract, because he should be banned from taking this job. If he never goes, that solves a lot of the problem. But it doesn't solve all of it, because a second concern I've got is that if he has wanted to get that job offer for the last few weeks, possibly the last few months, he's been thinking nice thoughts about this company because he wants the job. Self-interest threat. We may also therefore have to review any recent work he's done on this client to ensure he did not ignore financial statement problems in trying to get the job offer. And there we go. We have got ourselves our first question done. Some of the risks were easier than others, which is no great surprise. It's an exam. If it was all easy, everybody would pass. Notice how I tried to highlight what type of threat, explain why it's a threat, not just state it. Even when I'm doing the safeguards, try to put in some element of detail. 2 to 3 lines for each mark I'm trying to get. Don't get worried by some of the harder points. You always know there'll be some easier ones as well. And trust me, when a question like that comes up, 90 to 95% of students spot every point. So identifying the issues in the story is not the hard bit. You'll do that. The key is the explanation. That is what needs practice. What's nice about it is you don't just have to practice past exam questions to practice the explanations. You can do it in your head. The auditors have got shares in the client. That creates a self-interest threat because, now what would you write? The auditors might ignore mistakes in the accounts to try to keep profit high because that makes the value of the shares they hold be higher as well. Think the explanations, you don't just have to write them. Okay, well that's the first question out of the way. We're at roughly the halfway mark at that point, so I am going to suggest we take a little break for 10 minutes, just give ourselves a little refresher. When we come back, we will look at a second ethics question, which is a little bit different in some respects, just to give us some variety. And then we'll move on and look at some other technical stuff, and then start the second core area to finish off tonight's class. It is currently 7:22. So we will restart. At 7:32. See you in 10 minutes. Make sure you get yourself a little break. Okay, welcome back. Nice little break, but off we go again. As I was saying to you before break, second question we're going to look at looks very similar, but does have one very important thing to look out for. It's not a major thing that would stop you passing the question, but it's the sort of thing where you could, if you don't spot it, find yourself sitting there thinking, but where are all the points? Let's take a look at it. Second question we're going to look at goes a little bit further back, and I've chosen this one because it's a bit different. December 13, and it's question number 4. So there we go. Say I'm not making this up. Thursday the 5th of December 2013. And away we go. That's not it. Question 4, and as always, we will go down and take a look at the requirements. Now, we're not going to do every bit of this question. Why not? I hear you scream. Well, one of the reasons we're not going to do part B is that this came up in September 2015. Engagement letters do not come up very often because they're too easy. You can sort of see that, 2 marks, 4 matters. It's only half a mark per point. So we won't bother doing that bit because it's not really worth our time and effort. But part A is knowledge and worth practicing, I think. And then we'll get on to part C and the practical bit. So part A says, describe the steps that salt and pepper should take, so things that salt and pepper should do in relation to cinnamon prior to accepting the audit. Now, there are things you should do prior to accepting any audit, meaning that we can come up with an answer to that and then look at the story and see if there's anything interesting in the story that makes any of our points even more important. And to confirm whether the preconditions for the audit are in place. Now, the preconditions for the audit is a technical term comprising 3 elements, and that is why it is always going to be worth 3 marks. So all of part A I can plan out and possibly even write the answer to without ever reading the story, because it's a technical question and it's the same answer for any client. We will read the story just in case there's something in there of interest, but my plan for the answer to part A, I'm going to do just here. A part 1, things to do before accepting an audit. Well, before I accept any audit, I have got to consider things like the threats to my objectivity. Are there any conflicts of interest with other clients? I should assess the integrity of the client. Now, stories normally tell me things about clients, and maybe there's something in the story that I can use on that integrity point. I don't know. By the way, notice rather usefully here, conflict of interest is C of I. Integrity of client is I of C. Isn't that nice? Very reflective. I've also got to assess if I have got the staff, the time to meet the client's deadlines. I have also got to consider the potential audit risks and whether the audit fee is enough to cover the risks. Before accepting an audit, I should also ask myself whether I am competent enough to audit this client. Again, competent to audit this client. There might be something in the story about this client which I can add to that point. And I should also do something called professional clearance. So I am going to contact the previous auditor to find out if there is anything they can tell me which might impact my decision on whether to accept cinnamon or not. I don't need, what's that? 8 separate points? I don't need them. I need 5. So I would plan that out. I would then go read the story and see if any of those 8 have something of particular relevance in the story. Because if they are, they're definitely going in the answer. If not, you can pick any 5, really. And then part 2. Preconditions for the audit. Now, as I said, this is a technical term. It is found in Audit Standard 210. It has a fixed meaning. And it means that before you take on an audit, you must make sure that management of the client accept their responsibility or duty to prepare the financial statements, using appropriate accounting framework or accounting standards if you prefer, have an internal control system in place to prevent and detect financial statement errors, and thirdly, they accept their duty to provide all documentation, explanations, information, i.e. evidence. Now, in the current exam format, to have 8 marks of almost total technical with no practical is relatively rare. Not unheard of, but relatively rare. But that gives us a nice little bit of technical revision on top of all the practical stuff we're going to be doing. What we're now going to do is look at part C, and for that we're going to need a separate page. So in part C it says, let's bring it down so that I can point at it. It says, identify and explain yet again. Oh, my arm's disappearing again. So we won't do that. Identify and explain 5 ethical risks which arise from the above actions of salt and pepper. For each ethical risk, explain the steps to reduce the risks arising. So it's threats and safeguards again. Sounds like the same question as last time, but I don't know if you've spotted it, but there is one word missing in part 1. Let me show you what I mean. When I see the word ethical, I think of the 5 fundamental principles of ethics. A lot of people like to call this PICO. Not entirely sure why, because PICO means nothing to me, but it is the first 5 letters of those 5 fundamental principles. So we're talking here professional behaviour, integrity, confidentiality, competence, and due care and objectivity. Now, of those 5, the one that comes up on the exam the most is objectivity, self-interest, self-review, etc., as we've just seen. But the others all have their importance as well. They're just harder to examine because there's less examples and detail to put into a story. Thing is, the question we're looking at does not say objectivity or independence. Maybe I should just write that down there for clarity. It does not say that. If we go back and look at the question, it says ethical, but it never says the word independence or objectivity, unlike the other question. Which means these 5 ethical risks that we're looking for in here could be any of those 5 from PICO. It won't just be objectivity, independence, i.e. self-interest, self-review, etc. It could be others. Of course, it could all be independence. But the fact that that word is not there suggests to me she's going to make this one broader. When we explain our answers, therefore, we may be explaining threats to objectivity. We might be explaining threats to our professional behaviour, threats to our integrity, threats to confidentiality, or threats to our competence and due care. Let's go read story and see what is there. Salt and Pepper is a firm of chartered certified accountants which has seen its revenue decline over the past few years. Boo! The firm is looking to increase its revenue. Yay! And so has developed a new advertising strategy where it has guaranteed that its audits will minimise disruption to companies as they will not last longer than 2 weeks. Well, that looks interesting. Is there an ethical threat in there? Well, ethics, 5 things. Pico. If we make sure that every audit is done within 2 weeks and never spend any longer, are any of those 5 Pico letters going to be affected? We always make sure we do 2 weeks' work, no more. Professional behaviour? Not really. Integrity? Not really. Confidentiality? No. Objectivity? No. Competence and due care. What if the audit should have taken 3 weeks and you do it in 2? We've got ourselves a point. So the first one that I would put in the answer, hang on, what part of the question are we doing here? C part 1. So the first of the points that would go in my answer is if you stop the audit after 2 weeks, what if you're not actually really finished? So that's the first point. It's not an objectivity point. The solution to this is easy, by the way. You don't guarantee the audits are done in 2 weeks. Audits will take as long as audits have to take. Sorry. Right, back we go to the question. In addition, something else is coming. Or Salt and Pepper has offered all new audit clients a free accounts preparation service for the first year of the engagement, as it is believed that time spent on the audit will be reduced if the firm has produced the financial statements. Right. Well, I can see 2 separate ethical issues in there. One perhaps a little more obvious than the other. If you do a free financial statement preparation and then do the audit, hopefully you agree the most obvious risk here is an objectivity issue, the self-review threat. Remember, you must explain it, not just state it. If you check your own work, because you're auditing the accounts that you produced, you might miss or not confess, meaning you would then give the wrong audit opinion. Just to repeat from earlier, when you're explaining threats to objectivity, try to talk about the fact the audit opinion is at risk of being wrong or being seen to be wrong. But that's not actually the only issue in there, because it's not just financial statement preparation. It's free financial statement preparation. Doing work that is very cheap for a client, or in this case very cheap because it's free, is called lowballing. And that is dangerous because when we do work and don't charge so much for it, there is a risk that the work is or is seen to be lower quality than normal. If you're not being paid a professional rate to do something, maybe you will not carry out the work in a professional way, showing full care. Now, we all know that both preparing accounts and then auditing them is about the most basic threat to objectivity you're ever going to find, and it's probably best that you don't. It is allowable, if they're not a listed client, to have two separate teams and one does the accounts prep and the other group of staff do the audit. Yes, I agree, can be done. But it might be better, especially when it says cutting corners on the audit because you've already prepared the accounts. I don't think that gives a very good impression. Probably best not to offer both services. Or if you are going to offer both services, don't suggest that the audit work can then be cut because your firm did the accounts. A full audit would still have to take place. Excuse me. So we have got some objectivity threat cropping up here, but notice it's not the only stuff going on in this question. This question goes a little bit further. So that was point number 2. We're looking for 5, so let's see what else. The firm is seeking to reduce audit costs. I don't like the sound of that. Audit firms should not be cost cutting because cost cutting suggests quality, due care again. And has therefore decided not to update the engagement letters of existing clients on the basis these do not tend to change much on a yearly basis. Not one of the easier points in the question, but it is a point. So what's the issue? Well, what is the engagement letter? It's the contract between you and your client. But what if the client wants something slightly different from you this year? Maybe they don't want the audit done just the basics, maybe they want some extra services. Or maybe the way you're doing an audit this year is changing because the audit standards have changed. Your responsibilities might have changed. The company law might have changed. And all of that sort of stuff is in that letter. So there is a danger. That if you do not review if engagement letter needs changing, there is a risk that we have not included new duties in our audit process. And that is a lack of due care and also means there is a risk of breach of law, which would hardly be good for our firm's reputation, would it? Solution: you don't have to issue a brand new engagement letter every year. It's a bit like your employment contract. You don't need a new one every year, but every so often they should be looking at that contract to make sure it is still current and reflects what is going on with the client. You don't just leave ongoing contracts to renew and never bother looking at them. They tend to fall out of date very quickly. Not one of the easier points, but coming up next, I seem to remember, is something which comes up on a regular basis. One of Salt and Pepper's existing clients has proposed that this year's audit fee should be based on a percentage of their final pre-tax profit. Now, if you don't get it from that sentence, the next sentence is very helpful. The partners are excited about this option. Well, when we get excited about things, it's because what we're going to get from them, self-interest, as they believe it will increase the overall audit fee. Well, that pretty much explains to you what the issue is with number 4. What we've got here is an example of something called a contingent fee. That is where the audit fee depends, because that's what contingent means, depends on the outcome of the audit work. Because we, of course, audit the financial statements, including the profit figure. If our audit fee is dependent on the figure that we are auditing, there is a risk that we, the auditor, manipulate the client's profit to go higher. All we'd have to do is ignore any mistakes in the accounts, where if they were corrected, the profit would come down, which means we're giving the wrong audit opinion because we just want the profit to be high. We don't want it to be correct. That one, I will mention the solution, by the way, because contingent fees are banned. So they cannot be accepted. The audit fee should instead be charged based on the number of hours of work done and the grade of audit staff we used, and you simply multiply the two things together. You charge based on the hours of work done, not like that. Got 4, one more needed. Salt and Pepper has recently obtained a new audit client called Cinnamon, whose year end is the 31st of December. Cinnamon requires their audit to be completed by the end of February. However, this is a very busy time for Salt and Pepper, and so it is intended to use more junior staff as they are available. Professional behaviour, integrity, confidentiality, competence and due care, objectivity. Use lots of kids on audit. Lack of due care? Surely. Trainee staff? Probably not qualified. If there are more and more of them, they're harder to supervise. You need to balance it out with higher level staff as well. So notice we get another point, which is not a threat to objectivity. By the way, the contingent fee, I wrote it on the question, didn't write it here. Self-interest threat to objectivity. So I think that's our second objectivity issue. But number 5 is another lack of due care. Trainees are less capable. Need direction and supervision, etc. If you use lots of trainees, it increases the risk that the audit goes wrong. What's the solution to this? Well, if it's your busy time and the client wants the work done more quickly, you're going to have to say to the client, well, if you want it done at that time, it is going to cost you more money, because the only way to get it done at that time is to tell our staff they're going to be working overtime. And that's expensive. So if you want it quick, you can have it quick, but quick is not cheap. There is one more sentence. Additionally, in order to save time and cost, I'm thinking due care again, Salt and Pepper have not contacted Cinnamon's previous auditors. Aha, that's professional clearance. Mentioned it earlier in the answer. Well, that's a relatively straightforward point. If they don't do professional clearance, number one, that is a breach of our duty, because contacting the previous auditors is not a choice. You must. I would argue, therefore, that that comes under the P of PICO. That is unprofessional behaviour, because professional behaviour involves following the standards and rules of your industry, and you have not. It is also a lack of due care, because if you have not contacted them, you will not discover some issues which might be relevant to appointment, equals result you accept when really you should not have. So you're taking a risk. It's not just that you're breaching the rules. It's like going and working for a company but without checking out what the job involves first. I mean, you might be okay. There's a bit of a risk, isn't it? So, there we have it, my friends. 2 ethics questions done. Slightly different with the second one. The first one we did is far more common, all about threats to objectivity, but sometimes your examiner is going to expand the question into other areas of ethics as well. So just be alert to that. Look for the word objectivity or independence. If it's there, great. If it's not, just be a little more open to other things going into your answer. Right, wonderful. 2 questions down. And what we're going to do now is a little technical revision. It's got nothing to do with what we've done so far, but a little technical revision before we move on to the second core area to finish off tonight. Somewhere on your exam, there are going to be probably 4 or 5 audit standards. And you'll have to explain or apply the rules. Unfortunately, there's about 30 or 35 audit standards. You can't probably learn them all. Some of them are fairly easy and some require a bit of work. And on revision, there's no point me revising all of them, so I focus on those where a little more work is required, or things where I think it's got a chance of coming up. The one that I think probably has the most work and understanding requirement is ISA 560, which is called subsequent events. I think in understanding this audit standard, it is helpful to do 2 things. The second thing, which you'll see shortly, is a diagram. And if you can have that diagram in your mind, it helps to understand the various stages involved. The first thing is to realise that this is an audit standard telling the auditors what the auditor's duties are. It is not the same thing as the accounting standard IAS 10, events after the reporting period. Because accounting standards tell you what the accounting rules are. But because subsequent events is the auditor's duty after the year end, and because IAS 10 is events after the reporting period, which is how to account for things that happen after the year end, there must be a link between them. So before we revise ISA 560, auditors are checking the accounts after all. Let's make sure we understand the accounting rules. IAS 10 says this. Any event after the year end, now here's the key bit. This is the bit to remember and understand. Which gives information about the client's position at the year end is known as an adjusting event. So it happened after the year end, but we need to go back and change the year end financial statement figures to reflect this event. There are quite a few examples of adjusting events, some more obvious than others. Key examples would be things like a year-end receivable goes bad after the year end. The logic is if that customer can't pay you 2 weeks after the year end, they probably couldn't pay you at the year end either. You just didn't realise it. If someone goes bust today, well, they weren't a millionaire yesterday, were they? Another example, year-end inventory held at cost of $1,000. 2 weeks post year end is sold for $50. Well, that's an adjusting event. If it was worth $50 2 weeks after the year end, it was probably only worth $50 at the year end. Things do not change in value like that. All other events that happen to a company after the year end are therefore non-adjusting. So no debits or credits in the prior year figures. No need to adjust any of the numbers. However, if 2 weeks after the year end, Martians from outer space invade your office, take all the directors hostage and take them back to their planet, I know at the year end the directors were still there and there were no funny little green men around, but you know what? I think the shareholders need to be told about this. It sounds fairly important. So if an event after the year end is material, you leave the debits and credits alone, but in the financial statements, a disclosure note is required. So just to repeat, that was IAS 10, so that's a reminder of the accounting standard. But that links directly to the audit standard. Because if there are things happening after the year end which might require adjustment in last year's accounts that we're auditing, or might require disclosure in last year's accounts which we're auditing, then we've got to be on the lookout for them, haven't we? If they can affect the accounts that we are auditing, we need to be aware of them. And that is why if that's the client's year end, after the year end, the auditor has an active audit duty, which means you are looking for things happening after the year end which might impact the client's accounts, either adjusting or disclosable. But hang on a minute. Does this carry on forever? Well, no. Because if things could affect the client's year-end accounts forever and ever and ever, you'd never sign them off, would you? Which would be ridiculous. Therefore, the IAS 10 accounting rules only last until the directors sign the financial statements. The technical term, they are authorising them for issue to the shareholders by signing them. So up until the directors sign the accounts, IAS 10 is still going on. See? Which means you've got to keep actively auditing it. Once the directors sign the accounts, you know that's it. No more events after the reporting period that are relevant to last year's accounts. No more of them can happen. And therefore, shortly after the directors sign, your active audit duty can end, and you should now be in a position that you can sign the audit report. Okay. So that's the starting point of ISA 560. We have got an active duty to keep checking what's happening at the company until just after the directors sign the accounts. And typically, that's the end of the audit. But ISA 560 has got a secondary problem. And that secondary problem is caused by the fact that this whole process of accounts is not over until the accounts are laid before the shareholders and the shareholders vote to adopt those accounts as the accounts of the company. That happens at the AGM. Which means we have a potential problem. The first of which is that my line is not very straight, and I do not like that. Right, there we go. Because there is a possibility that at some point after things have been signed off, a problem arises. Now that green line that I've just drawn on there cannot be an adjustable or disclosable event after the reporting period, because that's finished now because of that red line up there. Okay, the vertical red line. We can't have any more. But what could happen after everything's been signed is that somebody discovers there's a mistake in the accounts that's material, which the directors hadn't spotted and neither did the auditors. Oops, nobody found it. These things can happen. Well, if those accounts have still not been shown to the shareholders at the AGM, there is still time to correct this. The interesting question, though, is what are the auditor's duties? You see, as an auditor, your active duty has finished, look. It finished when you signed the audit report. So you won't have found this mistake because you've stopped looking. But now a mistake has been found. If the client tells you about it, your responsibilities open up again. Exactly what those duties are depend on what happens next. So a material mistake has been found after the financial statements and audit report were signed. This can now go one of two ways. One possibility is that the directors don't want all the hassle because everything's been signed and say, nah, we're not going to change the accounts. Well, that's a problem because the accounts have a material misstatement in them, but you can't change your audit report because you've already handed it to the directors and they're very unlikely to hand it back. If you can't tell the shareholders there's a mistake in the accounts because it's too late and you've already signed your audit report, you've got to find some other way to tell the shareholders. So how are you going to do it? Answer, I don't really care, just do it. You could write to them, which you have a legal right to do. You could wait till the AGM, speak to them then. If it's a listed company in particular, you might even issue a press statement, maybe a stock exchange announcement to make sure that everybody hears. Just tell the shareholders. The rather more interesting, and by interesting I mean complicated, bit is if the directors agree to correct the financial statements. And this is why it is complicated. Back to the diagram. So they sign corrected financial statements. Wonderful. Number one, as auditor, you have now got a duty to check that the correction they've put through has been done correctly. Wonderful. So you've checked it and they've done it correctly. Good. Number two, check they have not altered anything else. Always a chance the cheeky directors have not just corrected this, they've gone and made the sales figure go up and done other things. So you'll compare the revised accounts to the original ones and make sure that's the only change. And then there's the tricky bit. You see we have a little problem on this diagram. IAS 10 says that events after the reporting period which are therefore potentially adjustable or disclosable, are all those events between the year end and when the accounts are authorised for issue, they are signed. Which means we have extra IAS 10 events after the reporting period in that gap. Some of them might be adjustable, some of them might be disclosable. And you don't know because you stopped auditing back here, which means you have got to extend your audit duty. In other words, audit all the stuff that happened in that time period, and only then can you issue a new audit report. New accounts equals new audit report. So just for completeness, we'll add that on here. Stage 3, extend active audit duty to audit the gap since the original audit report was signed. Now, up until that third point, this is not that difficult. So if you want to make your life easier, you might want to ignore that, because you'll easily pass this if you have to explain it without getting that far. So that's the hard bit. I could even take it a little bit further and say, what if the directors signed the accounts and they'd been sent to the shareholders before the AGM takes place, and now a mistake is discovered? Because now you've got the added complication that the shareholders have already got the original accounts and the original audit report. And if the client now sends them a new set of accounts with a new audit report, the shareholders will be very confused. Two documents, which is which? So version number 2 needs to say on the front, revised financial statements, and your audit report in document number 2 will need to say this audit report replaces our original report dated blah, 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 blah. But in 20 years of doing this job, I have never yet seen a student's answer get that far and explain it. You're never going to get there, so what's the point worrying about it? If it comes up, you can get full marks without ever getting that far. Just to be clear and for completeness, once you have signed your audit report, usually from there up until the AGM is called passive audit duty. You stop actively auditing, but if you are told anything or discover anything, you have to react to it. Passive rather than active. Okay then, so there we go. I think that's the hardest audit standard of them all. Doesn't come up that often, but it is overdue. So be warned. Just before we move on to core area number 2, which is where we will finish tonight, and we'll pick it up again tomorrow night, I will be giving you some tips of what I think might come up. And I will also be providing you with what we call our must, should, could list. Taking the last few years of exam papers and highlighting which questions you really want to do for this sitting, which ones it would be good if you can do, and which ones only if you've got time. I haven't done those as yet. It's still a little early for that. But at some point in the next week or so, hopefully by the end of this week, I will have those documents uploaded for you on your platform. Okay, let's finish our first evening with a bang. Core area number 2, audit planning, and in particular, audit risk and response. Now, with this part of the course, there is a little bit of knowledge, but it's not that hard. And there is a practical bit, which requires technique. The key bit of knowledge here, so literally just learn it and practice explaining it, is the audit risk model. So let's start with that. The audit risk model says this. Audit risk is the risk of giving the wrong audit opinion. In other words, it is the risk of material misstatement in the financial statements. The financial statements are wrong, and the auditor's substantive tests fail to find these misstatements. So one way to look at audit risk is to break it down into 2. However, there are 2 reasons why companies have mistakes in their accounts. One is the nature of the client, its business, its industry, its transactions. And the other risk of mistakes in the accounts is weak internal controls. Meaning that the risk of material misstatement can be broken down into two subcategories. This one is called inherent risk, and this one is of course called control risk. The auditor's substantive tests fail to find these misstatements. That is known, we'll do that in a separate colour, as detection risk. So audit risk is a combination of those two things, or if you want to break it down like that, those three things. The logic, therefore, is the auditor does this. The first thing we do is we look for the inherent risks. Why might this company in this position, in this industry, making those products with those staff, have a mistake in their accounts? Why might it happen? Stage 2. We then assess if the client's controls will prevent, or if they don't stop them, at least spot them, these inherent risks. Are the controls good enough? And then, stage 3, we set the level of our substantive testing dependent on stages 1 and 2. So in other words, if there's a lot of risk of the accounts being wrong, inherent risk, and the controls are weak, we must do more substantive testing to balance it all out. And that will help to bring detection risk, so that thing there, down because control risk is too high. So that is how the audit process works with risk. And ooh, we've all woken up all of a sudden. Hi Paul, would you please also upload the handout with ISA rules and explanations? Yes, I will. Can you give a specific example for inherent risk? Yes, I can. Can you? Haha. There are about 47 million examples of inherent risk. Okay, example. I'm auditing a bank. Banks have got complicated transactions called financial instruments. If they're complicated, there's a risk of them getting them wrong. Company is about to list on the stock exchange, which means they want their accounts to look super good to attract investors, which means there's an inherent risk that the accounts look far too good. Your client works in a high-tech industry where new products are coming out all of the time, which means inventory is at risk of overstatement because of obsolescence. Because as new products come out, older ones will have to be sold at a discount to get rid of them. I think that probably does for now. There are hundreds of examples. Hundreds, thousands. And learning the examples does not help. You need to understand that inherent risk is the risk accounts might be wrong because of what's going on at that company. The directors, for the first year ever, are getting a profit-related bonus. Risk, they cheat. Simple as that. Right, excellent. That is the model. That's the technical side. That does not earn you so many marks. If you're asked to explain the audit risk model, explain it. If you're not asked to, don't. The far more important bit is this. Which says something like, using the above information, explain the audit risks and your response to those risks. Very common question. Notice the word and, it's a two-part question. Risks, response. This is our second core area. And by core area, I mean areas where there is technique that you need to have and you need to practice. And for audit risk, the technique goes like this. Now, if you're asked to explain the audit risk model, I would do inherent risk, control risk, and detection risk. When you're doing the practical question and you're explaining actual risks, as a marker, I would not really care whether you write inherent or control. I don't care. The key is both inherent and control risks. Let's do it down here, actually, I think. Is that going to work? No. Is that going to work? No. That will, though. Right. All audit risks are either a risk of material misstatement or a detection risk. And that is important because that is going to impact how you explain the risks. Because if you are explaining a risk of material misstatement, you need to explain what in the financial statements is at risk of being wrong, why you think it's at risk of being wrong, and whether you think the number is likely to be too high or too low. If you're not sure, just say misstated. And in some cases, it might not be numbers, it might be disclosure notes. Whoops. Which means now the risk is the risk of under disclosure. If you think you found a detection risk, all you've got to do over here is explain why audit staff might not spot a specific mistake. Now, in audit risk and response exam questions, you've got two possible types of risk you could see: risk of material misstatement or detection risk. Typically, 99% of the answer is over here. No guarantees, there may well be one detection risk, possibly even two, but the vast majority of the answer will be risks of material misstatement. Because a key issue when planning audits is the ability to look at a company and say, right, we should focus on that area because I think they could get that wrong. So a lot of this is about risks of material misstatement. Now, the best way of taking this forward now, is to look at a question, which we will start doing tonight and we will carry on with when we start tomorrow's class. So let's go look at our third question of the night, back to the June 15 paper that we were looking at earlier, but now one of the 20-mark questions. Question number 5. So there's number 1 that we were doing earlier. We'll go 3, 4, 5. As always, we go straight to the requirement. Part A is a factual question, and I'll be looking at that tomorrow. Part B, on the other hand, let's just write knowledge up there. Part B, on the other hand, audit risk, response, practical. Notice it is very similar to the objectivity, threats and safeguards question. It's risks and response. Similar in the way the marks are earned. There's 12 marks available and you've been asked to come up with 6 risks. There will be more than 6 risks in the story. Now, audit risks are a bit harder than threats to objectivity. Most students spot most of the audit risks, but because most of them will be risks the accounts are wrong, that means we are talking accounting rules and debits and credits, and that is more complicated. So with this question, there's even more incentive to go and pick the easier audit risks in the story, not just talk about all of them. So a bit of prioritization makes sense here. It's the same marks whichever risks you talk about, and some will be easier than others. Part C is again a knowledge and understanding question that we will look at tomorrow night. So for now, let's start looking at Part B. Now, I've not even mentioned yet audit response. We'll worry about that once we've got the risks. Let's focus at the moment for audit risk. Rather like the ethics question though, I would put the responses over here and do it in a 2-column approach. So let me take you through the story and see what we've got. You are the audit supervisor of Maple, currently planning the audit of an existing client, Sycamore Science, whose year end was the 30th of April 2015. Sycamore is a pharmaceutical company. Now that in itself makes me a little nervous because they sound a bit complicated. Now the client will have experienced pharmaceutical type people working for them, so they should be okay. But as an auditor, the fact that they are a specialist in a difficult scientific industry says to me that is detection risk. Because that is complicated. So let's start with that one. Always explain everything. Aim for 2 to 3 marks. Audit risk. So we're either saying risk of material misstatement or detection risk. I think detection risk. Therefore, I need to say something like, there is a risk. Auditors do not detect certain financial statement mistakes because client is in industry needing specialist knowledge. Now that's a good start, but certain financial statement mistakes is a bit vague. I need to try and be a little more specific. So what might there be at a client which is specialist, which would be hard for me to audit? Well, it's not bank and cash, is it? Bank and cash is bank and cash. Receivables are amounts due from customers. They're just receivables. Payables, blah, boring. The two things I could put in here are either inventory, because complicated pharmaceutical stock might be hard for me to assess, and possibly some of the assets they use, the machinery they use, might be specialist and hard for me to understand as well. I'm going to go for inventory. For example, inventory valuation. Right, so there's a detection risk. Now, I've not even focused yet on audit response. What is response to risk? Well, it's literally what you would do about it. So use a bit of common sense. Your client has got specialist stuff going on. You're worried some of your audit staff won't know what they're doing. Response, find some audit staff who do know what they are doing. Need to put some, doesn't have to be all specialists, specialist staff on the audit who have audited pharmaceutical companies before, or if you don't have any, use an outside expert on the audit. That's an auditor's expert. Go and get someone from outside your firm and hire them to help you with the audit. This paper is trying to escape. Okay, so there's one, a detection risk. Excuse me. It then says they manufacture and supply a wide range of medical supplies. Interesting. I see the word manufacture and I'm thinking a couple of things. If they're manufacturing a wide range of medical supplies, standard costing is probably being used. You know, labour, materials, overheads. That can create complications. But I don't want to start making too many assumptions. I've got a big story here. I've only got to find 6 risks and, ooh, there are 6 paragraphs. Could that be a clue? So make a note they're a manufacturer, but if she wants you to talk about that, there'll be more information coming up, I'm sure. Excuse me. Draft financial statements show revenue 35.6, profit before tax of 5.9. Why do you think you are being told those numbers? Because that will help you, if other numbers are given, to assess materiality. Remember, it is the risk of material misstatement. If you can calculate, calculate. Okay, it then says Sycamore's previous finance director left the company in December 14. So the year ends 30th of April, so 4 months before the year end, previous finance director left. After it was discovered he had been claiming fraudulent expenses. Ooh. I think we have got a risk of material misstatement. Because any expenses in the financial statements might be overstated because of fake items claimed by the XFD. I've said why, I've said what, and I've said over or understated. Response? Review his expense claims in detail. But you've already been told that they've left because they were committing fraud, so the client's already known about it. And ask the new finance director for information about how much fraud was discovered. Notice how the response to the risk is common sense once you know what the risk is. The difficulty, though, is you can't come up with a response if you don't understand the risk in the first place. Back to the story. A new finance director was appointed in January 15, so 3 to 4 months before the year end, who was previously a financial controller, not financial director, lower level, of a bank, which is rather different to a pharmaceutical company. And she has expressed surprise that Maple had not uncovered the fraud during last year's audit. That last bit, her surprise, that's to do with the first part of the question, an auditor's duty relating to fraud. But there is a new finance director. Looks to me like they've not been a finance director before and they didn't work in this industry. That creates risk of material misstatement. Quite a few of them, actually. Oops. For example, the new FD has only recently been appointed. Seems new to a finance director role and previous experience was not in this industry. Leading to increased risk of mistakes throughout the financial statements. Hard to be specific. If they don't really know what they're doing, there is a risk they could make mistakes anywhere. Eek, tricky. So what do we do about this? Good question. Well, this seems to be a control risk because the finance director controls the accounts and they might not know what they're doing. So I think what we've got to do is assess the finance director's competence and what the company has done to help the new finance director overcome their lack of experience. And if we don't think that's enough, we may need to increase our substantive testing, substantive procedures in all financial statement areas to compensate the potential control risk. Now, we've not got very far with this question so much. The risks, well, one was a detection risk. The risks for the financial statements have been a little bit general so far. As we move on through the story, we will discover some more specific risks where we can really put our technique into practice. And that is what we will do in tomorrow night's class. We will pick this question up again and carry on with it before moving on and looking at a slightly different type of audit risk question and how that works. So we are at 8:46. In fact, you've had a bonus 1 minute, you lucky people. We are at the end of tonight's class, and that means I get to do this. Way, there is St. Paul's, the lovely St. Paul, lovely St. Paul's Cathedral in the background there on this lovely grey night in London. Thank you all very, very much for partaking in class number 1 of revision. Tomorrow night, class number 2 of revision will occur. And just to repeat, we will pick it up with that question before moving on. Thank you all. I will see you tomorrow evening. Good night.